Gary Cohn also said people are underestimating the capex boom you could get this year. Do you believe in that as well?
We do, actually. Even before the tax reform sort of gelled, we were seeing some of the indicators like the Fed Philly right up at 1984 highs. And just to put it into context, that same theme is playing itself out in Germany with the ZEW, Tankan surveys in Japan. We're getting a very clear still signal in China that the companies are still willing to invest. So the actual capital investment theme is actually still got to play itself out over the next 18 months. And it's not just on tech, it's a lot of hard capital goods equipment as well.
So, Sean, you've got a thematic trade in there, and it's the spending theme that you want to get allocated to, you want exposure to. Talk to me about how you're doing that.
So that can be anything from makers of photocopiers, leasing companies, all the way through to construction equipment companies. It's actually quite a broad gamut of companies. And I think it's possibly... You've got to bear in mind, the last 7 years, the corporate sector globally has had a very high profits relative to GDP. They've hoarded that money. Yeah. Capital holders have done well, and we're just starting to get that money being recycled into the economy.
Jill, we've seen the pickup in capex towards the end of last year. Is it something you can see us building on through 2018?
Yeah, I mean, I think there's certain factors that certainly argue for a pickup in capital spending, and we track guidance on capex by companies, and you've seen that ratio tick up to its highest level in years. Companies are guiding up more on capital spending. I think what could be a headwind is that capacity utilization in the U.S. is still at low levels. So typically when you see capacity utilization reach around 80%, that's a level that typically precedes a capex pickup. So, global and U.S. capacity utilization are still at lows, but with tax reform and with the cyclical recovery, there's sort of offsetting factors there.
Sean?
I think it's going to be an interesting earnings season to see what the chief financial officers say about the accelerated depreciation, because I know a lot of time has been spent on the repatriation, but this is the first time we've really seen in 30 years a changes to the accelerated depreciation. So I think that's the thing to look for. And I think the litmus test will be that companies have made record profits to GDP and now big potential change in the spending pattern.
So what's your base case with that in mind?
I think the S&P industrials still continue to inflate. So I think that's the best sector to actually play that out.
So that's interesting, because through last year it was about fading the Trump trade, fade the Trump trade, fade the Trump trade. Do you think it reverses and goes the other way through this year?
Yes, I do. I think what's happening now is that the markets are becoming more and more aligned to a cyclical reflation trade, and it's combined with what's happening internationally, but you've got everything combining into 2018. So Trump, global reflation, and an international revenue theme as well with capex.
Jill?
Well, in terms of the Trump trade, we think that at this point it's largely priced in. And that wasn't the case all year. You saw a lot of these stocks surge in earlier in the year, and then as tax reform became less uncertain, the relative multiple of these stocks came down through the fall. And then all of a sudden, as we got more momentum and as it ultimately passed, now these stocks are trading back at a 5% premium to the market. So I think at this point, tax reform is largely priced in, and we're not really expecting multiple expansion on this at this point.